It's Matt Santacapital from the Santa Saul's Houses team, and I wanted to give some commentary on the recent Bank of Canada rate increase. And arguably I'm maybe a little late to the game here. However, I kind of felt the need to more kind of sit back and just see how the market was going to react to this and put together a bit of data to support some of my ideas. So let's jump into it. I do have call it some slides to show that are going to show some data that helps support kind of where I think things are going to go. So let's get into it. All right, so a couple questions that we're going to cover. What does the rate increase mean? Will rates continue to increase? How will it affect the housing market, variable versus fixed? How will it affect buyers? How will it affect sellers? What to do if you're on the fence and housing prices are coming down? Shouldn't I wait to buy? These are just kind of some topics that have been asked or questions we've been asked over the past little bit. And so I thought I would, just give my insight, so to speak. So let's just start. What does the rate increase mean? Well, so in short, what occurred on July 13th was essentially the Bank of Canada, or the BOC, overnight lending rate increased by 100 basis points, which was a slight shock to the market. Everybody was expecting 75 basis points. And essentially it means that money is going to cost more. And it's primarily unsecured credit that's going up. So if you have an unsecured line of credit or a variable rate mortgage, things like that are going to go up. Now, in reality, rates have been very low. However, you could argue that they have fueled some of the issues that we're seeing right now with, costs going up. One of their big reasons for this rate increase is inflation numbers. So currently, as of June 22nd, inflation in Canada is sitting at 7.7%, which the Canadian government and the Bank of Canada has deemed is way too high. We typically like to sit around 2.5%. And so they've chosen to combat the inflationary pressures that we're seeing with rate increases. So that's in short, I guess, what's going on. Now, what I want to show here is what has the Bank of Canada interest rate policies looked like over the past, call it 3 years. So roughly between January 2019 to March 15th of 2020, the overnight lending rate was sitting at 1.75%. COVID happened, scared the bejesus out of a whole lot of people. And on March 16th, they dropped it 100 basis points to 75. And then again on March 27th to 25 basis points, which is essentially call it money was free. Really, it's kind of nuts that they did that. I know a lot of people felt that. Maybe a lot of people didn't voice it, but it really didn't make sense that they put rates as low as they did. Then what happened on March 2nd, and this was once it was very evident that inflation wasn't going away, and once kind of, I hate to say it, but the U.S. Fed and the Bank of Canada, they used to say inflation's transitory. No, they got it wrong, and they generally always do get it wrong. Inflation was here to stay because it's a supply chain inflationary issue. But anyways, so on March 2nd, they added 25 basis points or 0.25% to the overnight lending rate. Now, they were saying they were going to do this, and they've kind of eased into these rate increases slowly. Then again, on April 13th, they went up another 50 basis points to 1%, then another 50 basis points on June 1st, and then on July 13th, the expectation was 75 basis points, but they went a full percentage point, and it's because inflation is getting worse. Now, they haven't been hiding this. Months ago, 2-3 months ago, they started saying that the overnight lending rate target is going to be 3.5% by the end of the year. Now, the only thing that you don't really know when they make a statement like that is, for instance, are they going to try and get there in July, or are they going to try and get there in December? Regardless, we know that's where the rates are going unless we start to see something drastic. And that drastic change that needs to occur for them to change this policy that they have chosen is you need to see inflation numbers drop. So if inflation doesn't drop, the Bank of Canada is not going to stop raising rates. They may, if they see other economic indicators, unemployment starts to really go up and the economy goes more towards into a very evident recession, then we might see them stall. But that's going to take a good year or 2 years for them to see anything like that. So the first slide that I kind of want to show here is, or graph I should say, sorry, is the Bank of Canada rate versus housing prices. And this is for the London St. Thomas Association of Realtors. So if you just talk London, Ontario, and you draw a circle around it for about 30 minutes, 40 minutes, that's kind of a general idea of our territory. So we officially saw record home prices March of this year with a median home price of $770,777, which is kind of a funny odd number, but that's the way they shook out. So anyways, what also occurred and that number is at the end of March. At the start of March, we started to see rates increase. So we had seen for quite a while, again there, for almost 2 years, call it, or the better part of 2 years, the overnight lending rate was 0.25. And with that came dirt cheap mortgage rates. Now, let's just be honest here. Dirt cheap mortgage rates are going to force prices up because you can just afford more house. Now, after the April 13th rate increase, again, is when it was very evident that we started to see these, the drop off in housing prices. So I think it's very clear that, as rates go up, prices come down. The easiest way to think about it is interest rates are gravity to home prices. And it's because your payment changes. And that means your dollars don't go as far. That's just it. It's been a continuous trend, as you can see here, where we went from a high, again, of March of 777,000 down to June, just last month, of a median home price of 650. That's a very substantial swing to occur in such a short time period. And again, we went from, in March, 50 basis points overnight lending rate to 250 basis points. So that's a big drastic change. What I also, though, wanted to point out is that that's not the only change that occurred. What we have also seen is a drastic increase in the number of homes on market. So number of homes that are for sale. At one point, I believe it was in January, we had a little under 2 weeks worth of inventory. Now we're trending to about 2.5 months worth of inventory. And most likely in the coming, call it 3-4 months, we will probably full on be in a balanced market. In the end, that's where they want to push this, because the market that we were in was really not a safe market to be in for the long term. But you can see as housing prices dropped, inventory went up. So we kind of have two big items, the main drivers actually that are affecting the median home price, which is interest rates are going up and inventory levels are going up. So people have more selection. So it is just natural to see a softening of home prices. You could argue this is happening a little too fast. It's shocking how fast prices have come down. However, it is what it is. This is the market we're in. Now, to answer the variable versus fixed question, I know that historically speaking, variable rate mortgages, they say, you always end up better off. And that's because your rate really does have to go up quite a bit more than what your fixed rate is for it to really make that much of a difference. However, I'm going to be honest, me personally, I've always had fixed rate mortgages, and I'm a commission sales rep. So having that steady knowledge of what my payment will be for my home in my terms has always made sense for my family. It just seems to be the way we've always liked to do things. But I think when we talk rates, where we get lost is, we think, oh, it's only 1%, it's only 2%. We never really think about what is the real dollars and cents involved here. And, it even gets frustrating to say, one of the big things I see is, the 1% rate increase only represents $50 per 100,000. Okay, that's great, but can we just start talking real numbers for once? Because whenever someone says that, you always have to stop and start doing the math of, okay, so if I've got a $500,000 mortgage, my payment's 50 per 100, okay, it's up 250. Let's just give people the numbers. And that's what I wanted to do here, to really show that there are some pretty significant swings here going on. So the example that I took was if you purchased an $800,000 home You put 20% down. So there's no, and why I did that is I wanted to eliminate the mortgage insurance premiums. It's a 25-year amortization and a 5-year term. So in here you can see May of 2021, and I chose that because that was kind of like the low point in mortgage money. What I mean by that is that's when kind of the best deals were out there. There were some other, little snippets of time where you could get a little bit better of a deal on a fixed rate, but this was kind of in general a good point of a very low rate for your mortgage. So looking at May 2021 with variable, if you had a $640,000 mortgage, you could get a pretty reasonable, application would go in and you get a 1.55 rate. And that works out to a payment of $2,573. Now, which is, okay, rent now for call it a 2-3 bedroom is actually that. So why would you rent a place when you can buy a place? It made total sense. Well, let's fast forward, and these recent rate increases and the changes to the variable rate mortgage space, they're not discounting the rates that much anymore. And what that means is that just it's not as competitive a space for the people who are lending money for mortgages. That rate is now at 4.25. That represents an increase of $3,454. Or more importantly, let's just ballpark it as $900 a month more in disposable income is required to pay for that mortgage. Now, looking over at the fixed rate mortgage, in May of 2021, a very reasonable mortgage rate that you could get was 2.34%, and that represented a payment of $2,816. Fast forward to July right now, that same 5-year fixed rate mortgage, you're looking at about 5.19. So it's doubled, which translates to a payment of $3,792. And again, we're talking about $900 roughly, a little under that, of increased payment. The key here to think about, though, and this is where when we say, oh, it's just 1%, it's not a big deal, these are historic low numbers. Well, that $900 or $850, a month is $10,000 a year. Now, when you start to really look at income levels, that's a substantial amount. So for an example here, I Googled this, I think it was a week or two ago, so I'm just relying on the website I was on. But the average household income in London is about, call it 70,000. It's just shy of that. The reality is that if your mortgage payment for the year goes up by, $9,000 or $10,000, it is substantial. So you have to be kind of naive to not realize that this will have an effect on housing prices, and the overall sentiment of the market. One interesting thing to note here too, though, is as these rates go up, your qualifying rates get pushed up. So right now, the variable rate mortgage qualifying rate is actually 6.35%. Now, the qualifying rate was introduced years ago as a safety measure to ensure that people could handle these increases. So, some people get very scared when the rates go up. You really shouldn't, because it's kind of like these rate increases are baked in, as I kind of like to call it. They're just, we know we can afford it. However, on the flip side of being able to afford these changes, you do have to adjust your spending. You maybe aren't going to take a vacation. You aren't going to go and, buy more clothes or do things like that. You're going to do more stuff where you're, sitting at home with friends, hanging out in your backyard instead of going to, Canada's Wonderland. Maybe you just go to the beach. You will adjust your spending habits. That's without saying. You just will. So how will rate increases affect buyers here? So, well, the reality, we're going to see fewer buyers. There's going to be qualifying issues. And again, that's just, there's only so many dollars that you have to put towards a mortgage payment or rent. This is also going to increase inventory. So the benefit of being a buyer is you're going to have more selection. That's just it, right? Houses are taking double the amount of time to sell. So inventory levels are coming up. Really, I think that's actually a good thing. So sales are dropping, and again, ties into the inventory levels. But what more importantly is happening is we're being pushed back into what's called a balanced market. So roughly about 6 months worth of inventory, which, let's be honest, I think if you were to, ask anybody in the real estate world, most of us would rather work in a balanced market. It just feels good. It allows both sellers and buyers to get into a win-win deal where they, one doesn't feel hosed over the other. I know a lot of buyers over the past recent few years have felt it's really been way too one-sided in favor of the sellers, and I would agree, but that's just the market. Conditions are coming back. So we have quickly started to see financing conditions, home inspections in there, sale of a home. That's just it. They're coming back, which quite frankly, I think is, again, another good thing. We realistically, at the end of the day, agents, I think, we're always trying to do what's right for our clients, which is, if you're a buyer, to buy the home. And we were in an environment where there was way too many offers going in on houses, and you just had to submit firm offers. There was no way around it. It's nice that things are dialing back and getting back to a bit of a more sane market. The other thing that is going to happen here is some deals won't come together due to tight affordability. We've already started to see a few deals where, there was a financing condition on the sale and the buyer couldn't firm up because they just couldn't qualify. The numbers were too tight. Now, as agents, our option there is to kind of come to the table and maybe see if we can make things work. In some cases you can, in some cases you can't. The thing to remember with this, though, is this is where it really comes in to get your pre-approval done. Now, and I mean a true pre-approval as a buyer. If you go in and you speak to a mortgage broker, wherever they are, whatever institution they're a part of, and all you do is give them some numbers, you never really give them documentation, and they just kind of say, well, based off what you've told me, you can afford this. That's not a pre-approval. I mean, get your documents in, get your pay stub, your NOAs, show them where your deposit's coming from, and actually have them do a rate hold. That's your best way of operating. In the end, the last thing you want to do is have a general idea when we are in a shifting market where, because the documents weren't in and you were slightly off on, let's say, what you said your income was, and then you were slightly off on what your debt levels are, and your debt levels are really higher and your income's really lower, well, it will affect you. So, dot your I's and cross your T's. How will the rate increase affect sellers? Well, sellers, we finally have a lot more competition. Like I said a second ago, we're trending to a balanced market. We're still not quite there. I think we'll be there in the London area over the coming months. Back are the days of time on market. And what I mean by that is, most homes aren't selling in 2 days. We are going to go back to, it's going to take you 2 weeks, 3 weeks, 4 weeks, trending to even, possibly 2 months to get your home sold. That's just what happens in a balanced market. And conditions are back. So as sellers, even though 3 months ago everything was on fire, it was firm deals, you got everything you wanted, you're going to have to accept the idea that people are going to have financing conditions, people are going to want to do home inspections, and people are going to start throwing in the conditional of the sale of their home. That's just it. That's the reality of where we're going. But more importantly here for sellers is first impressions are now matter again. And that means you do have to present your home in the best way possible. So, prep time. 3-4 months ago, you could just wake up one day, decide I'm listing my home, throw a sign on, and you would get crazy activity. Nowadays, we are going back to the preparing the home properly for sale. So that includes cleaning up the exterior, weeding your gardens, getting some fresh mulch in there, some fresh flowers, painting your front door, giving the interior of the home a deep clean, fixing all the little items that you've ignored maybe for the past 5, 7, 10 years. We're going back to a time where, again, you have to do the work to get your home sold for top dollar. And we're heading back there quick. It's no shock that if you have looked at realtor.ca, there are some homes that have been now sitting for, 30, 40, 50 days. And, they just don't present as well as they should, or they're not priced to where the current market is. And the big question, one of the things, what to do if you're on the fence, honestly, buy. And my reasoning behind that is, to me, when it comes to purchasing your personal residence, so the home that you and your family are going to live in, that's a long-term purchase. Even though housing prices might drop, if you find the right house, it check marks all the boxes and you can afford the payment, I would buy it. Even if I had a crystal ball that said, okay, in 2 months, the price of this home in theory would be 5% less, I would still buy it because I'm not selling it in 2 months. You should be intending to live in your home for well over 5 years, realistically 10 years. It doesn't really make sense to be moving, buy a home and move in 2 years and 3 years. Buy something that works for at least 5 years, And just like everything, I mean, we say, our financial advisors say this, it's like your key to returns is just being in the market. Holding off to try and time the market is dangerous because as much as the values have dropped quickly, they can go up just as fast. And the example would be is if all of a sudden the Bank of Canada realizes they move too quickly, we could wake up tomorrow and they could announce, the rates are going down. And then all of a sudden, you're behind the eight ball again. Now you're back to, okay, now I've got to find that house that really works for my family and myself, right? So, and housing prices are coming down. Shouldn't I wait to buy? Well, I kind of answered that, I guess, in the previous, question, but I would just emphasize, I wouldn't wait. I would just buy what makes sense. So as an example, if you need a 3-bedroom, don't buy a 2-bedroom because it'll work for a year or two. That doesn't make sense. Go and find what you need. So if you're a young family, and let's just say as an example, you have 1 kid, but your intentions are to have a second, well, buy the house that's going to work. Buy a 3-bedroom or a 3+1 or a 2+1, depending on what you're after. And don't. It sounds weird to say it this way, but don't settle. Just be okay with, okay, no, we found it, now let's go and get it because we can be here for 5 to 7 years. Focus on key neighborhoods, schools, proximity to schools or school catchment areas, I guess is the better wording. But the other thing is amenities. That's the other thing, is back to the old idea of location, location, location. When it comes to real estate, as long as you apply a long-term perspective to, buying, well, the reality is if you focus on location, you're always going to win. As long as you can focus on time with that too. Something I'm going to add here again is back to like the Bank of Canada and the U.S. Fed. I like to say the U.S. Fed because they work in tandem. If, let's say, the U.S. Fed announces rate increases, you can almost guarantee we're going to see the same thing in Canada. It's almost like they're just talking to each other and kind of Canada is following along. But I will say this, they consistently kind of do the wrong thing, and it's maybe not the nice thing to say, but they generally don't get things right. And what I mean by that, or what I may be alluding to, is I think at the end of the day, at some point, they are going to raise rates too much, and they're going to be forced to drop them again. We've seen this in the past. And then again, that'll kind of fuel could fuel, again, another tear in the market. And by tear, I mean like another upward trend. And we just never know when that's going to happen. One of the ways you can kind of try and get an idea would be to watch employment numbers and economic growth. The other thing, though, that why I would say I would buy now, and this is maybe the one that I haven't heard too much talk about, is a lot of the issues we have right now are supply chain issues. And those issues are not going to get fixed through increasing interest rates. So if you really start, and the easiest aspect in the real estate world to talk about with this is new construction. So for instance, if interest rates, let's just say whatever, they go up to the 3.5%, the overnight rate, that doesn't change immediately, at least, the cost of a lot for a builder, the cost of a permit, and it really doesn't kind of solve the trade problem we have right now, where we do not have enough skilled tradespeople to meet the demand for the new housing sector. The issue that's going to occur there is, even though as rates go up, we see prices coming down, new construction is still going to be very expensive, whether or not we like it or not. And that's just, the input costs are too high. A 2x4 is still too expensive. Concrete's too expensive. Everything has had that massive inflationary pressure. It's not uncommon right now to see a 2,000 square foot, new build home in the city of London over $1 million. It just isn't. And that's not really that massive of a home or elaborate of a home. And the reality, though, is that payment's getting expensive. So, these rate increases won't affect that segment as fast as they probably would like. To fix supply chain, you need new industry creation, and we're not seeing that. That's one thing that's been ignored on the inflationary side here. So until we kind of see some chatter about, either how we're going to get the Canadian dollar to strengthen, or how are we going to get more 2x4s made in Canada? How are we going to get more electrical wiring? And also, how are we going to get more tradespeople, to run the cabling, to do the plumbing, to do the roofing, to pour the concrete foundations? Those conversations I don't think are being had. So, and I think they're important to mention here, because that is going to be also one of the things that actually keeps housing prices potentially higher, which maybe is kind of the weird one to throw out there, but it may. Anyways, so again, hope this brought some value. It's a little bit of a long video. If you have any questions, throw them in the comments, or feel free to reach out to any of us. If you have a unique situation and you just want to throw around some numbers and get an idea of what what your options are when it comes to mortgage financing, or even, quite frankly, even unsecured debt. We are not obviously finance experts. However, we don't mind just having some basic conversations, throwing down some ideas, and even trying to connect you with maybe the people you do need to speak to. So if you are looking for a mortgage, feel free to reach out. More than happy to connect you with some of the amazing mortgage brokers that we work with. And if you have any questions about, the real estate market, or more specifically, the pocket that you live in, because every neighborhood is slightly different, again, reach out to us. We're more than happy to answer any questions. So again, thank you.